In this episode, we're answering some of your questions. We'll be covering the challenges in trying to do strata due diligence when you have a property selling within days of being listed, what to do when your strata manager won't respond to you, at what point should investors consider selling due to land tax, why East Coasters turn their nose down when it comes to Perth property, and our thoughts on modular and kit homes.
Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent and buyer's agent mentor, co-host of Foxtel's Location Australia, author of Auction Ready and co-host of Your First Home Buyer Guide.
And I'm Chris Bates, mortgage broker, recently ranked number 5 in Australia out of over 18,000 brokers in the annual MPA Top 100 Mortgage Broker Awards. Before we get started, I need to let you know that nothing we say here can be taken as personal advice. We always recommend you engage the services of an appropriate and experienced professional.
All right, our first question is from Angela. And she says, I saw a property that had a Saturday and Thursday inspection scheduled. Vendor's agent had a strata report available for $300. They said that it was that price because it was a lot more substantial than the $30 before you bid reports. Because of demand, they scheduled another viewing for Tuesday, so the second day for inspection. By that afternoon, the property had sold for $715,000. It ticked boxes, except that it was 55 square metres. How was anyone supposed to do any due diligence? Your only option was to rely on the strata report organised by the vendor. What are your thoughts there, Chris?
Oh, it sounds like so the second day inspection that afternoon is on the Tuesday, and they saw the property on the Saturday. So I don't know, how long was the list on the Wednesday before that? So was it online viewing for 6 days? Did anyone organise a private viewing? Did someone see it on the Friday or the Thursday? But even still, it was on the market for a good, potentially 6 days. A lot of that due diligence potentially could have been done in that fast. Properties sell a lot faster that potentially. You could have seen offers on the Saturday. So I think in this scenario, potentially there was time, but it didn't feel like there was much time just because of how fast it moved. And unfortunately, this is how fast you potentially do have to move. Now, if it sold on the Saturday, I think you're right. I think if that was the first viewing and it sold that afternoon, did someone really look at the strata report? Did they really do their due diligence? Probably not. But that doesn't mean that they did. Because unfortunately, this is one of the challenges with buying is that some people will overlook due diligence because they are just trying to get the deal done. And unfortunately, that's just potentially not going to give you enough time to do your due diligence. That doesn't mean you should not do it yourself. But yeah, it's fortunately good properties can move this fast. And this even potentially took 2 viewings, not just 1.
Yeah. And look, it is interesting because I read this and I think, well, there's a number of you got to break down the question, right? The line about the report being more substantial from the agent saying this one's $300 because it's more substantial than another one that might cost you $30. That just sounds like a line. It's actually potentially crap because at the end of the day, wherever you get the report from, if it's been provided by the vendor beforehand, the before you bid model, if you've listened to that episode, you'll know that there's various cost structures for those reports. So it's not like you get a $30 report because somebody spent 5 minutes looking through the strata documents. It's because they're selling lots of reports, and in fact they'll usually charge the successful purchaser a success fee on top of that as well. So that's just sounds like an agent that's just spinning it. So you sort of pass that aside. The reality is that strata reports are difficult for a number of reasons, and one is because it does take time to get one. You've got to get access to the strata records. The person has to book an appointment, go in there, read through them all, put together a report and send it to you. And sometimes that can take a week. So if you're going to get your own, you need to have that time available to you. So if a property is going to turn around within a couple of open houses and there is a vendor's report available, you are reliant on that vendor's report. But also the reality is that there's such wide variety in the record keeping of strata managers and also the ability of somebody to write a report. So there's a wide variance. You could get your own report. It wouldn't necessarily be any better or worse than the vendor's one. So unless you actually know what a good report should contain, how to read it, how to look at the gaps in that information that is in that report, and to be able to assess whether or not it's something that you can rely upon to purchase that property or not, then, just getting it yourself isn't necessarily the solution. And so this is one of the problems that a lot of people think, I've just got to get my own strata report because that's going to be better. Maybe, maybe not. You need to learn what should be in that, what information is you're looking at. And that is something that even as buyer's agents has taken years to learn, because it's actually really difficult to learn how to do that. I've certainly in my business now 15 years old, and in the early days, I went around looking for people who could teach us what was in a strata report and what to look at. Took forever to learn that stuff. So that therein lies a real problem. So you might get a strata report. You don't know whether it's a good one or a bad one. You might get a lawyer to look at it, but are you using a lawyer or conveyancer that does a lot of purchases of strata property? If you are, then they might be really good in terms of being able to look at that report and advising you on it. But if they're not, they may not. And some refuse to look at the strata report. They say, no, that's not our area of expertise. So you're sort of thinking, okay, well, I got one. That must be a good thing. Some people don't do any due diligence, as Chris mentioned. They give up because they think, well, if the only way I'm going to buy a property is to turn things around super quick, I'm just going to have to hope. Hope is not a strategy. So there's lots of reasons why a property can sell quickly, and there's lots of flaws in the due diligence process executed by most people, because basically most people have no idea what to look for. So that's not a very comforting answer to that question, though, is it?
Yeah, but I think your point around having a conveyancer/solicitor that will look at the strata report for you might cost you a few $100s, but having that up front, so having your conveyancer and making sure that they will do it for you, because particularly ones that do look at lots of them, can go through and see if there's any major issues and can basically stop you making a big mistake. So I'd absolutely make sure that have that person in your team ready to go, have a commitment that they're going to turn it around in a reasonable time frame for you. And potentially you've got to get ahead of it. So if you see a listing come on that could be a property, it looks great, ticks all your boxes, ticks your price point, then potentially you think it's going to turn around fast, then maybe you just order the strata report. Maybe you get it checked prior to even doing the viewing. A lot of apartments, you could probably get that feel that it's going to be a good contender, rather than you go to the Saturday, oh, I love it, just like you thought you would. You ask for the strata report to be checked. That doesn't come back till Monday afternoon. By then, other offers on the table, you're chasing your tail. So whereas you could go to the Saturday open and then maybe you're really just thinking about, well, what's the price that I think's fair for this? What am I really willing to pay? Rather than, hey, I've got to get the strata report. And I would say that might be something you just want to consider if stock's moving fast, is you have to do that due diligence prior to even seeing it.
That's absolutely right, because there are buyers on agents' databases and buyers agents too, or we certainly get access to properties often before their first open house, or at least we know about them, and we know enough about the areas in which we buy that we also know good buildings, and we think, okay, if it checks out on the inside, then we know we're going to go for this property because we know a lot of a lot of other information about the property itself, the building, and also the location. And so, yes, we have done that. We have preloaded, if you like, our due diligence, and then going through the property is almost like just the final rubber stamp. It's like, yes, it is as good as we thought it might be, and we've done everything, we've done all our checks. And some buyers who've been in the market for long enough, and also some buyers agents, will have actually gone in and they're ahead of the eight ball already, So therefore, that is one way that people actually look like they turned around something really quickly, but actually they didn't. They took their time and did it properly. And the thing too is, if there's a whole Monday available, as Chris said, if you have a lawyer or conveyancer who is a specialist in strata, and that is absolutely something that we encourage you to find somebody who does a lot of conveyancing in that space, in the strata space, then, and you've got them already lined up, that's exactly what, in Home Buyer Academy, which is our course for first home buyers, that's step one, getting your support crew. It's getting everyone lined up so that the minute you see the right property, you actually know exactly where you're going to go to get that advice. And that includes a broker as well while you're at it. All of those people that you need for advice in order to make that final decision and go for a property, you can have all that set up and ready to go. So that's really how you turn around a property and you get everything done, and you don't take shortcuts when time is of the essence and properties are moving quickly.
Yeah, I mean, a prime example, clients try to buy a property in a postcode that's got a bit of a higher risk rating at the moment. And, they've already fallen in love with the property and It's actually a good asset within that postcode. The banks have put restrictions on their LVR in terms of what they'll lend on that postcode. So it's kind of like a needle in the haystack, and that's probably discounted into its price already. But, we could have potentially, if they came to us last week and said, we're really going to go look at this property on Saturday, and, we could have had these conversations with them around the issues around LVRs. We could have checked on the postcode and said, actually, this could be a bit of a waste of time. And so, definitely try to do your D-Day if it's a likely property that's going to suit. Buyers agents, absolutely. If they're looking for a great house on a great street and they're looking for months and months and months, and they get a sniff of something off market that's going to tick their box and they're going to get free access or early access to that, then they've usually got the building and pest happening an hour later, right? The contract's already getting checked and they've already requested that, and offers are on the table, that same day. And so you can still do those strategies yourself if you're buying. So what's our next question, Veronica?
This one's from Stanley. My question, if not already raised before, is around land tax, one of my personal bugbears. But anyway, at what point should investors consider selling an investment in Sydney and spread this around the country? I have an investment in Sydney, I won't say the suburb, which I pay $30,000 on one dwelling. That's a big land tax bill. The capital growth does ease the pain, and land tax is deductible, which also helps. The New South Wales government takes approximately half my rent, that's presumably in land tax, and has no responsibility over the property. I could rant all day, so could I. I'm definitely not after financial advice, just a discussion around this annoying tax, so I don't feel alone in paying this every year as it increases. I would also like to spread the narrative that seems to be lost with renters regarding this tax. Most people, not investors unless they haven't met the threshold, aren't even aware or even understand how this tax works. And secondly, the media narrative is around unfair landlords raising rents without addressing the true costs of being an investor. Keep up the great work. Love the show. All right, Chris, can you briefly explain how land tax works?
So it's a state-based tax, and it's not based on the value of the property. It's based on the value of the land that property is attributed to it. And it's usually a conservative valuation, to be honest. You get those valuations. You go, no way in the world I would have sold that land for that price. And so that's a good thing, right? Because, if a property's worth, say, $3 million and the land's worth $2 million, but you're not going to be paying land tax on the value of land worth $2 million. It might be 1.5, it might be 1.2 million. They're usually massively conservative. And so, and then what you get is a threshold amount of land that you're allowed to own as an individual. And per property in different states, it's based on properties, not based on like the entity, based not on the total accumulation of your land. So you've got to be careful because it changes. Different states charge different taxes, but generally you get a threshold. So you're allowed a certain amount of land before you start paying tax, and your house isn't included in your land tax, right? So it's one of the benefits of owning a home is you don't pay any tax on the growth of that land, and so you don't pay any land tax, and it is deductible, which is a big thing, because if land tax wasn't deductible, that would absolutely wipe out a lot of people, because it basically be 40 or 50% more. We wouldn't get that deduction. So in New South Wales, I think he said it was Concord, didn't he? Is that right? Yeah.
He did, but I wasn't going to say it, but it doesn't matter.
Yeah. Okay. Sorry. Apologies. They're paying $30,000 of land tax. That might be the land value might be worth $3 million in this scenario. I've just done a quick calculate online. Is that right?
But it also could be that he's got another property that tips him over the threshold, and then this is the sort of the bigger value one,
That's a good point. Yeah.
So it depends on how much property you've got in any one jurisdiction.
Yeah, exactly. And so roughly it's about $1 million you're allowed before you start paying land tax in sort of New South Wales, a little bit over than that. And you can sort of go online and look at the percentages that you'll be charged on top of that. Look, I think in this scenario is that he's probably got some significant capital gains in this scenario. And while I think it's an expensive tax, I do think that that's not going to go away. And I think there is going to be a pressure on investors owning land and this is what the housing affordability bill will be on. I think it's going to force investors to try to sell homes to get them off the rental market for housing affordability, get them to buy more apartments and things like that, which is better for the rental stock. So while it's not a great tax, you can see why it also suits maybe the broader picture to have that tax there. And it's an easy win to take money off investors. So should you sell it, it's really how much capital gains tax are you going to basically pay by selling this? If you've owned this for a long time and It's always been an investment property. You never lived in it, and you've got a $500K tax bill, and you then you might go, well, I don't really want to lose $500,000 out of my estate. So if I sell my property for $3 million, I have to pay $500,000 tax. I've only got 2.5 left over, plus what I had in the mortgage. You know, maybe I've only got $1 million or 1.5 cash. Maybe I can't borrow much at the moment because borrowing capacity is really tight. And so you've got to be really careful selling, because you might not be able to get as much leverage as you have now today. And then you have to pay this big tax bill. So if the only cost is really potentially paying this land tax to hold, and it's a good asset and you think it's a really good asset long term, then I'd be really hesitant selling it for land tax reasons, because you could pay a huge capital gains tax bill and you might not be able to get anywhere near as good asset in the marketplace. And it sounds like it probably would be positively geared as well, because generally these sort of bigger properties are, because you've owned them for a long time. A lot of people don't buy them in recent years. They bought them a long time ago.
I agree that land tax is not very well understood, and we don't have a dumbo in the Q&A episodes, but I'll give you one. It's my own personal dumbo for many, many years ago. And so I had my own principal place of residence, and I also had bought a house as an investment. And then I chose to move out of my principal place of residence into my partner at the time. And so I rented out my principal place of residence. And so I had the 6-year rule there to rent it out until I purchased another principal place of residence. And my accountant didn't mention anything about land tax liability. I was only thinking about, tax via the ATO, because land tax is not via the ATO, it's via your state government, right? So about 3 years in, I get this letter from the state government, Office of Office of State Revenue, with a rather sizable land tax bill, because it accumulated over 3 years plus a penalty, and for both properties as well, because obviously one of them was over the threshold and the other one was also. And I was incensed, and I rang them and don't you realise I've got a 6-year rule? And they went, well, don't you realise this is a state government, not the ATO? And I went, what do you mean? Went to my accountant. Can't believe you didn't tell me about this. I'm only worried about your tax return. It's not something that I have to worry about. Anyway, sacks the accountant for starters. The state government, Office of State Revenue, took pity on me because I must have given a good enough sob story. So they took off the penalty, which was very kind of them.
Yep.
But I still had to pay the land tax. And that was a very big lesson learned, because I'd bought that investment property, the house, without even knowing. And I was a sales agent at the time. So I was not a buyer's agent back then. I was a sales agent. I had no idea. I'm in real estate. That's my chosen career, my chosen profession. I had no idea. And so if I could be in the game and not know about land tax, it's a zero surprise to me that a lot of investors have no idea and could equally get caught out when they get hit with their first bill. One thing I would just, further to Stanley's comments on tenants and the bad rap that investors get, tenants don't actually care. They don't care about the costs that the landlord has to bear.
No.
Regardless of whether it's fair or otherwise, they do not care. They just don't want their rent to go up. And I didn't either when I was a tenant, so I totally get it, right? But I am still astounded that the narrative around investors remains so negative, even with such a rental shortage, that no one seems to be able to draw that bow or, to join the dots to go, oh, if there's less investors around, those greedy people supposedly that are taking my rent, less investors mean less investment properties, therefore pushing up rents. I mean, it just astounds me that sort of those two concepts can't seem to coexist in a lot of people's minds. I think land tax does suck because you pay it regardless of the income that you derive from the property. And also, while the capital gains do make it seem worthwhile, there are some years that don't see price rises. And the price falls don't automatically roll out into lower land taxes and rates, because the rates are calculated from the unimproved property value, the land value. And interestingly enough, I just got my land tax bill yesterday, and I looked at it, and I looked at the actual land value fell last year, according to the Office of State Revenue, but the year before that it was higher. And you go, well, actually, that's interesting because last year prices rose, but the year before that they fell. So it appears to be no correlation with what's happening in terms of the market and what they determine the land value to be. I think talking about spreading the land tax risk across different jurisdictions or different states is a very good thing to think about before you buy, definitely not after. And there are a lot of considerations before selling an investment property that Chris was talking about before, particularly the tax considerations and thinking, and really I would never encourage anybody to sell based on one cost alone. You really do need to think of a number of issues, and I'll just quickly whip through some here. And I do have a little masterclass that I'll put the link in the show notes to as well, which actually takes you through a framework to work out whether you should, in fact, sell an investment property or not. You've got to be looking at market conditions, where you're at in the cycle and why periods of price growth are rarely one-off, right? You got to look at what your plan was when you bought the property versus your plans now. Are you on or off track, and how do you measure performance? What's the caliber of the asset? How good is it? And is it worth keeping, and how do you work that out is important. And what will you do with the money if you sell? And have you considered those tax implications that Chris was talking about there? And then do you have the right advisors? Do you have an accountant, financial planner, conveyancer, property advisor? Do you have those people on board to make sure you're looking at this holistically? And then lastly, you need to time that sale. You need to understand the listing process, how long it takes to get on the market, what you do with tenants, how you give them notice, whether you should sell with them, et cetera, and then how do you choose the right sales agent? So there's quite a number of things to go through, steps to go through before deciding to sell an investment property. Definitely our advice would be not to do it just because you don't like paying land tax.
Yeah, I like that last one as well there, where you try to time your sales. So in this situation, you might say, look, it just doesn't really make sense to me to hold this because of the land tax, because I'm not, I could do something better with the money. I could pay off my home. I could put more money into my super. I could buy a cheaper investment property. I could restructure things, right? So they may make that decision, but it doesn't mean you go and put the property on the market now. You may say, look, I want to sell it maybe in 2 years' time. It's a bit where maybe I've retired, or maybe there's more momentum in the market, or, or maybe when there's, less listings or a bit more stronger. So you kind of have to, don't just rush to your decision there. I think ultimately, though, if you think about it, this is just another reason why it's going to be harder and harder to rent a house in the more affluent areas of capital cities, because, they're the ones who are generally going to have the biggest land tax bills attached to it, because, it's got to be $1 million of land. I mean, while we're there, Veronica, with that land tax bill, was that still very conservative, the land value they used on those properties?
Well, compared to this particular house that I'm thinking of, where I saw that the land value go in the opposite direction of what the market did, if I look at what it would cost to build the current or to replace the house, it's not conservative at all. But at the same time, that house is underutilized. Like, I could get a much bigger house on that block of land, so therefore, it's sort of it's not highest and best use, put it that way. So it's hard to break that down. And this is, a lot of people think, the property's value is basically the unimproved land value plus whatever it costs to build something on top of it. It doesn't actually work that way. So when you actually look at it, I would say the land component is according to the Office of State Revenue, is higher than when you broke it down to the dwelling and the land, if that makes sense.
Yeah, I see what you're saying, but you're probably not sure if you'd still sell it for that. If you had to, the house burned down, whether you would sell the land for that amount. I don't know. Because if it was really felt high, then there's also State Revenue would be getting lots of complaints. Oh my God, you can't, how that land's not worth anywhere near that amount, and it would just create a whole nightmare for them. So, generally speaking, you probably want to undercook that to stop all those complaints and just get people to start paying this tax, which they've already got issues trying to get the money back anyway. But I think ultimately what this is, it's disincentive to own land and more expensive land in our capital cities. And so what that means is that every year investors are thinking about this. So you're one of those investors who's got a house in the capital city that's going, am I better off to sell this? And what's that's good is what they're trying to do is get you out of an investment property into, say, free it up for the home buyer market. And so what that means, if you then take that and say, well, I'm going to sell this house, well, that's one less house for rent in the inner ring of Sydney or in that suburb. And that won't be bought by another investor because of things like land tax. And so it'll go to a home buyer. So now it's actually harder to rent a house in that suburb. And this is what will consistently play out over the next decade, for example, where every time an investor's looking at the numbers and go, look, I don't really want to sell it, but I don't want to pay land tax anymore, and I've got to sell it at some point, and maybe it's a good time to sell it now. The market's really hot. I'm in my 70s or 80s. Let's just get rid of it. And I think you're going to find in a decade it's just going to be ridiculously hard to rent a house in the more affluent parts of our capital cities.
I'm on a personal mission to help more people make better property decisions. And you can find out all about what I'm working on at veronicamorgan.com.au. And there you'll find resources for first home buyers, details about my buyer's agent mentoring program, access to suburb help for investors, or if you're looking to buy your dream home or an investment property in Sydney's inner west, eastern suburbs or lower North Shore, you can connect with my team at Good Deeds Property Buyers.
If you're thinking about buying your first home, upgrading to a new one, or purchasing an investment property anywhere in Australia, we would love to carefully guide you through this journey and importantly get the finance right. Please reach out via our website, wealthful.com.au.
Don't forget that you can download our free full or forecaster report. Which experts can you trust to get it right? theelephantintheroom.com.au.
Just on that, and we all know that we've got this chronic rental shortage, and of course, apartments, you could buy, say, a house is worth $1.5 million, and you had the choice between a house and an apartment, $1.5 million. Your land tax liability on that apartment is going to be a hell of a lot less than it is on the house because, of course, there's less land attributed to the apartment. So if, as investors, you can see that, if you can find A-grade apartments, there's a lot to be said for buying them versus houses because you don't have that additional land tax liability. And typically you normally get a better rental yield on an apartment, all things being equal as well. That said, so this particular house has just come up for rent, and it needs a new kitchen and bathroom. It's livable, but it really needs it. And I worked out whether now's the time to do that or not and decided it wasn't. And interestingly enough, the property manager advertised it for a midweek inspection. So it's a 2-bedroom cottage with a very dated kitchen and bathroom and parking. And they had nearly 90 groups pre-register for a midweek 15-minute inspection. Nearly half of those turned up, so sliver over 40 groups turned up in 15 minutes. Like, I don't envy a property manager at the minute either. I definitely don't envy tenants or prospective tenants. 18 applications, 3 of which were in excess of the advertised rent. It's just mind-boggling. And I do absolutely feel for tenants. It's an absolute nightmare out there for tenants. But yeah, you talk about not many houses on the market for rent, and you talk about landlord bashing, then, it looks like greedy landlord, sure. But the reality is this is the first time that I've actually managed to exceed my rent that I was getting for the property that back in 2016. It dipped because the market dipped, and then it dipped because of COVID, and it's only now that I actually am now back more than, but it's the first time it's been able to exceed what it was back in 2016. So there's no talk about that. There's no talk about what landlords did in COVID for tenants. So I'm in agreement with Stanley on that one. All right, next question. Tristan, nice short one. I'd like to hear your thoughts on pre-built and modular buildings homes. Are they cost-effective versus building via traditional methods? I think the first thing let's talk about is finance.
The finance is sort of the key in all this, which is why you probably want to talk about it first. But they make a lot of sense from a practicality point of view, from a build point of view. You can build in a warehouse. No matter what the weather's doing, you can build more efficiently. You can use a lot more machinery. You transport it on site, put it together in hours like an IKEA. But, and you can get some very expensive and some beautiful designs. And, they make a lot of sense. And, we had Archie Blocks on the podcast many years ago when they were still in business. And I've tracked them, and they've got better and better, to be honest. Like anything, they innovate, they get better, they get more efficient, the price points get cheaper and things like that. The problem is banks don't like them because banks can't control if something goes wrong and the building company goes under, and some have in this area, and you want to do a construction of a house on a piece of land, but you want to do a modular home. Well, the builder's not going to want to build the whole house and then say, hey, don't worry, mate, I'll build it all, I'll put it on the land, then pay me after, right? After I've connected it up, because it's too much risk for the builder. The builder wants to get stage money across the build and to protect themselves, right? And they need to pay their staff and their things like that. So the builder wants the money as they build, but the bank doesn't want to pay it until the build's finished, connected up and ready to go. And so there's
until
this
it's left the factory.
Well, even on-site, connected. A bank doesn't want to have to sell an asset that's got a, half-built, sort of kit home on it, right? That's not all connected and things like that. So this is where years ago, I was trying to get finance for Archie Blocks, actually, to be the broker for it. And I went around and knocked at all the banks. And I don't think that banks have even changed their policy on this. It's too much of a small thing on their list of, driving credit growth that's going to drive more credit growth. It's just not a priority. And so that would be if it changed, if banks said, particularly with partnerships with some modular builders and said, right, we will lend 80% on the end construction value and we'll back you, that changes the game. And these modular build companies would have more work than they could handle because they make a lot of sense doing renovations. But if you're cashed up, you don't need a bank. That's different. That's their buyer. Cashed up downsizers, people buying, doing builds with cash. Modular homes can make a lot of sense and can lower a lot of risk on builds because you've kind of built off-site. You're not kind of building with the natural, like doing a renovation and having to, adjust it, and a lot of those things take a lot of time and cost a lot of money. So modular homes can sort of just be built in a factory, put on a truck and then dropped off, and it can be done in that wastage is not there.
I mean, you do see them, in sort of country blocks as well, on acreage where you've got more space.
Yeah,
because,
for sure.
I mean, let's face it, not all sites are suitable either, and they've got to have access for the big trucks to deliver, the big bits to all go together, or crane access or whatever it is that they need in order to get access. So I think that's something as well. But yeah, I sort of pore over some of these sites, particularly the weekenders and things like that, and I think, these, some of them look really architecturally very interesting, but some look like sheds. In fact, some are sheds. So I've actually seen some modular build companies that are quite literally, and they don't even try to pretend that they're not. They're like sheds turned into something that looks like a house. So which is, I'm not quite sure what the regulations are of different council areas, because that's something that needs to be taken into consideration as well. And also, you need to think about your future market. Always think about your future buyer. Always. And if it's in an area where, that modular home of whichever type you're going for, the more architectural style, or perhaps the remodeled shed, if that's acceptable and desirable in that marketplace, then great. And yes, sure, you might be doing it to live in for 20 years. Sure, you might think you're never going to sell it. But I think that's your exit strategy. That's your get out of jail free card always, is to think, if something should happen to me, if my life changes, if I need to, if I want to, will I find a buyer who is prepared to pay more than I pay for it? And that's fundamentally a good question everyone should ask before buying anything.
Yeah, I think you're right. There is the kind of the granny flat modular type, like a shed that is like more of an IKEA house. And, that might save you some money over doing a kit home versus doing something architectural. But and you'll go and sell it one day, people will value it like it's and particularly it would age fast and, wouldn't, stand up to the elements as well as, some other places,
cost a
right?
fortune to cool.
Yeah, exactly. But if you go look at, I know Archie Blocks, I think they're still in business or something, so be careful. I don't want to say they weren't in business, but I think they went through some challenges a few years ago. But if you look at places like Modscape, Pre-Built, Eco-Live, like these are premium, options, and they'd be very desirable, even in the most affluent suburbs, if they were done well.
Yeah.
And, it's just whether you're building it on site or whether you're building it in a shed. And sometimes building in the shed's more efficient and can be built better with all the machinery and things like that. So don't discount it, assuming that they're all not great quality, because I think some of these companies have are leading, setting the standards in lots of different things. I would say so. I
agree.
I would love bank finance to do this, because I do think, anything that can support the construction industry to build great stuff and to make renovating cheaper and more efficient, and the waste that we have. But I think banks just don't want to play ball with this because it's just too risky, and they just don't need to take that risk. If banks were really struggling with credit growth, then they'd go, well, what else way could we lend more money? That's just not their challenge, right? They
and also if you're serious about increasing the construction of dwellings, then the government would get in there and finance it, or find a way to finance it, or encourage the banks to finance it, or whatever. Because at the end of the day, we got quite a chronic housing shortage in this country, and in many ways, modular housing, pre-built housing, can provide a very plausible solution to getting dwellings up quicker. So there's something our government should be certainly looking at, including in their policy discussions. That's for sure. All right, our next question is from Ruth. I have problems with my Strata manager. She is not replying to my emails. I've asked her whether solar panels are covered under Strata insurance. I also need to make an insurance claim for bathroom cupboards. She did the claim on my behalf, but no reply after 3 months. Can I make the claim on my own? Now, I went to Amanda Farmer, right, for this one. So she is the host of Your Strata Property podcast. So I would encourage anybody who is a Strata owner or considering being a Strata owner to listen to that podcast, because she also has a membership that you can join, where you get access to ask questions of experts. So I think there's obviously Amanda, she's a Strata lawyer, but there's also, experienced Strata managers, I do believe, that contribute to that forum. So I've asked Amanda, and this is what she says, but I've also got a few things I think we can add at the end of this. And Amanda says the owner can't claim on their own, as the policy is in the owner's corporation's name, but they shouldn't be waiting for the OC to make a claim. The owner can simply ask the owner's corporation or the OC to pay them the replacement repair costs they have forked out, and how the OC deals with that, that is recovering under its insurance or not, is a matter for them. The owner does need to be careful, however, that the OC is actually responsible for the repair. She said, if I were to dig further, I'd ask, why do the solar panels and bathroom cupboards need repairing, replacing? For the OC to be held responsible, there needs to be some breach of their legal duty. Bathroom cupboards, for example, are not usually something the OC is responsible for on a wear and tear basis. And she said that she'd work through that in the members Q&A forum, when members can actually provide more information and ask questions of the experts. And so we'll actually put the link for that in the show notes. But I thought also we could talk about what you do when you can't get a reply from your Strata manager, because I had a problem a little while back where my Strata manager went completely AWOL and I could not get an answer out of them. And I thought, this is ridiculous. I did actually reach out to Amanda at the time. I'm a member of that group. But, what did I do when I couldn't get reply from my Strata manager? I shook the tree. I can tell you I vigorously shook that tree. I found people on the Owners Corporation, because I used to be on the Owners Corporation some while back. I went through all my old emails and found people. I looked at the minutes from the last meeting and found the people and the emails, and emailed the people on the committee saying I can't get hold of the Strata manager. I also found as many emails as I could find from the same company, just trawling through my Gmail, and I started peppering them with who is responsible. I finally got a response, and weirdly enough, we had a new Strata manager who, had been particularly quiet, and our Owners Corporation, our executive committee are quite self-sufficient, so they didn't need to bother this person. But it certainly got that person to be a little bit more visible, that's for sure. And I found who it was and got the answer to my question. But it is infuriating. It can happen.
Well, I have no doubt that you would have got to the end of that, Veronica. But I think you're right. That's the strategy. You just got to, not call. If calling an email is not working, get creative, and I'm sure you'll find a way for them to take action. I wish people did get back to people. Sometimes your values aren't what other people's values are. Maybe they're just flooded, to be honest. You've got to have a bit of respect here for some of the Strata managers, that the amount of buildings and defects and issues and they're probably putting fires out all over the place, and it's the fire that's the loudest sometimes that gets put out. So, yeah. And Amanda Farmer, I mean, I think that's exactly what I was going to say before reading your notes on air, is just go speak to a strata lawyer and really understand your rights, because, no one's going to know it like she does.
Yeah. It's funny though, I went to the last AGM with that new strata manager, and it is very interesting. We talk about record keeping, and I mentioned earlier when we're looking at strata reports and the record keeping that there's no set rules in place for, it's certainly not in New South Wales, as to how records need to be kept. So you're sort of relying on good business practices, but also good individual record keeping practices. And, because I used to be on the committee, and there were questions around, we're doing a bit of upgrading works on the block, and there were questions around sort of historical decisions. And because I had used to be on the committee, I had the memory, and I was able to remember what had happened, because the strata manager had no idea why certain decisions had been taken in the past. And it comes back to that record keeping and that handing over of records, and it's very imperfect, let me tell you. There's a lot of work that could be done in that space. Alrighty, last question from Elizabeth. I've been listening to your podcast for more than 2 years now, and Perth was rarely mentioned. Good to see that it is finally the case, and she's referring to our episode with Ray Chua, Perth buyer's agent. She says, I'm a Paris woman who migrated to Perth 18 years ago and watched the city flourish, and definitely deserves not to be categorised as a mining town anymore. My question is, how come there is still a misconception from people from over east about what Perth is about, especially when it comes to the property market? What do you reckon? Do you reckon there is a misconception, Chris?
Oh, I would say so. Like, I went to Perth, kind of trying to remember what it was. It would have been at least 8 to 10 years ago. And cities can change a lot in that time, right? I was going for a wedding in Margaret River, and I thought, well, I actually went for a drive around with Ray back then to show me all the areas. Where do people really want to live? Where's the up-and-coming areas and things like that? And I think unless you've gone there on holidays and you've gone down the coast or up the coast and things like that, and I don't know, it takes a long time to shake that. But you're right, cities are growing, populations are increasing, different jobs, different migration and things like that. And so, yeah, I just think people haven't sort of gone and experienced it in any recent years. And I think it just takes a long time for those perceptions, a long way away from the East Coast, right? So the flight and the time difference, and so people aren't holidaying as much as maybe they're going up to Brisbane or the Gold Coast and just seeing it, or have friends going there and talking about it as much. I think it's maybe just stuck in the old perception. But I do think that there is there's been a positivity around Perth, but in that episode you could also see that we're trying to temper that a little bit to say that doesn't mean that everything's going to go up, that the Perth market's just going to boom and everything is going to you're going to have to be really careful what you buy there. And so, yeah, I think there's almost an overconfidence in Perth now, that rather than an underconfidence in a decade of bad performance.
That's a funny thing too, because perception is a funny thing, right? So we're on the East Coast, and our perception is that there's a bit too much positivity around the Perth market. There's a lot of very positive noise, and coming off the back of a decade of crap performance, you got to be careful, right? Because it's like, memories are short, right? But also clearly, because Ray had alluded to this too, and then we've got this question, perhaps on the West Coast, they've got this enduring perception that East Coast people talk down Perth all the time. Maybe they've got a chip in their shoulder. I don't know. But that's all about perception. So we're thinking, hang on a minute, everyone's talking Perth up. They're over there thinking, hang on a minute, people are still talking it down. So I'm not quite sure who's right there, but I do think that understanding that it really, really, really has delivered very, very poor results for a long time for the majority of people that have held property there, that is something you've got to be very, very careful about. Darwin is not on the radar. Well, we're not talking up Darwin. I don't hear anybody talking up Darwin, but Darwin's had a shocker, And so is that going to happen next? That everyone thinks, oh, well, Darwin's got to have its day. Eventually it's got to revert to the mean too. You know what I mean? It just because it's had a period of poor performance doesn't automatically follow on that it's going to have a period of good performance. And I think that there's a bit of positivity around Perth that I'm concerned isn't based on fact. And just because a city's become a little bit more mature in terms of lifestyle, is that enough of a fundamental change in terms of the foundations of a market to result in, long-term sustainable growth? And I don't know about that. And maybe it's my East Coast bias. Maybe that's exactly what Elizabeth is referring to here. But it does take a while for perceptions to change.
Yeah, and I think, she's moved there from Paris 18 years ago. You want to sort of see people consistently moving there, right? Maybe she was a bit of against the grain back then, but maybe she's seen in the last 3 to 5 years that shift, right? A lot of people moving back who, from lots of different countries around the world. Perth's the city they chose. Maybe they don't just work in mining, they work in lots of different employment sort of verticals. Maybe you've got a lot of people moving back to Perth from the East Coast because they can't afford what they want and they're getting to the family stage. Absolutely, that happens. So, yeah, you want to see this sort of, the city driving its next evolution of growth to be more than just people moving there for work and mining jobs. And if you're seeing that and you're seeing this real scarcity where people aren't leaving the city and, particularly people are going to other cities for more money, for example, and then that's a really strong element of growth or signs of growth. So, but yeah, you do need it consistently long term. And so maybe we've seen that in the last few years. Are we consistently going to see that over the next decade? And there's no reason why you wouldn't, to be honest. So, I think it has taken a long time for that to be the case, though.
I think one closing note on this is fact. The fact is that the largest proportion of our population is on the East Coast. Our two biggest cities are on the East Coast, and then Brisbane's our third biggest city. And so therefore, with those three cities combined is basically half the population of Australia, a bit more than half the population of Australia, actually. So that's a fact. And then you've got this one city on the other side of the country. So that's always going to make it different and certainly going to create some fundamental differences between the two markets as well. And I don't think you can use the same assumptions you might use in an East Coast capital that you would use for Perth. So I think that when buyers from one area have decided they're going to put their money in another area, quite often they do make assumptions based on where they're coming from. And I think that is a danger as well. You've got to understand those local dynamics and work out whether they are sustainable in the long term or not. But we'll try to keep our bias out of any commentary on Perth.
And I'd say that's one of the things that concerns us around the Perth market, right? Are people who are pushed out of the capital cities like Sydney and Melbourne, are they moving to Perth, or are they moving more up the coast to, say, Brisbane, the Gold Coast, Sunshine Coast, or to Central Coast or Wollongong or Mornington Peninsula, or, are they even going to Adelaide over Perth because it's, the time difference is a bit better and the flights are a bit easier and things like that, which we've seen. So I think that's as population grows, is it just people first moving to Australia? Is it people from Perth moving back to Perth? Is that what's going to really drive the economy over the next decade? Or is it also that plus people moving from the East Coast? And I would say that's a little bit doubtful, I would say, from what we've seen clients and where people are willing to move to unless they're from Perth themselves.
Alrighty. Well, thank you all for your questions. We really appreciate them. And we've also had some really interesting suggestions for guests and episode topics. We are working on some of those, so I just thought I'd let you know that, and keep them coming. Keep reaching out to us and letting us know what you'd like to hear about. Thank you.
Thanks so much.
If you have a question that you'd like us to answer in an upcoming Q&A episode, you can send us a voicemail or written question via the website, theelephantintheroom.com.au, or you can email us directly at questions@theelephantintheroom.com.au. If you like what you're hearing, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars would be great. I know that sounds a bit cringy, but we have it on good authority that every review helps make it easier for other people to find out about us and hear what our amazing guests have to say.